Thanks for joining us for the Executive Series. Today I'm speaking with Stephen Glass, who is responsible for managing the Pengana International Equities Fund. Stephen, it's good to talk to you.
Thank you for having me.
Now, your remit, if it were, is a global one. We're at an interesting point now in the investment cycle. Rates are bottoming out. We're seeing a lot of friction being created by the trade tensions between the US and China. How are you putting your investment thesis together?
Yeah. No, Tom, this is an excellent time to be investing in high-quality businesses outside of the US internet-linked growth names. We think this for three reasons. One, there are some superb businesses out there that are delivering great growth and have had demonstrable track record of delivering the sustainable growth. And we think there's a lot of structural drivers to underpin a continuation of that growth to go forward. So there's some industrials and capital goods companies that I can talk to and that fit that theme. As well as that, there's a market positioning. At the moment, a lot of these stocks outside of the US internet growth names have been neglected by the market. The market is concentrating in these growth internet names, and rarely that's creating value elsewhere. Which brings me to the third reason why we think these companies are very interesting: valuation. A lot of the companies we're looking at now are trading on very reasonable valuations, free cash flow yield above 5%, PEs below 20 times, and we think that given the growth and the fact they're being neglected and we've got that valuation there, they are very interesting. So, for example, we have invested in a Swedish capital goods company called Sandvik that makes capital equipment with aftermarket sales for mining companies and manufacturers. This is a world leader in its space. It's got the aftermarket business to continue growing and has structural drivers as we get a rebound in mining capex. We've invested in chemical companies like Celanese, which dominates the world's acetic acid industry. And that whole industry is actually doing very well at the moment because there's tightening capacity utilization as Chinese capacity has been taken out because of its environmental regulation. We've invested in Antofagasta, which is one of the world's leading copper companies that will benefit from global GDP growth and the emergence of EV cars. And I can go on into other sectors, but the key point is there's a lot of value out there in superb businesses if you actually look beyond where the momentum is at the moment.
Okay, so that's one lens to apply. What about the geographical lens? You talk about the United States being the epicenter of the internet names. That means that you're basically looking elsewhere.
Well, we are looking a lot in Europe, and that's where we've actually, I would have thought that we've got just about the most European exposure of any global fund in Australia. I don't know that as a fact, you can't quote me on that, but that is certainly a place where we are going as lone wolves.
That's around 38% of the portfolio.
About 38%, yeah. And we're going out as lone wolves because we're finding value in these really world-leading businesses that are on good valuations that we think they're just being neglected by the market. So we own a business called Wacker Chemie, which is a world leader in silicones and silicons. We own, as I mentioned, Sandvik. We own Atlas Copco. We own Heineken. Heineken is actually delivering very reasonable growth at the moment because of its emerging market exposure. So we're looking increasingly to Europe. We're looking increasingly to Asia and emerging markets, which are multi-year low valuations. And yes, we still look at the US, but we're not looking at the high growth popular names that we feel have become very crowded trades.
Okay, so some of the underperformers, if you will, have been ABN AMRO in recent times, obviously a very strongly focused European financial organisation. Is that just a flash in the pan, as it were, or are they going to somehow start executing?
When you say underperformance, you're talking about Europe versus the US?
Yes.
Yeah, look, Europe, there's a number of issues. It was doing very well, but then their PMI started to deteriorate and people have become very concerned about trade wars. And Europe is a net exporter, so there's fears that the European economy is going to slow down. So that's really what's happening with ABN AMRO. Banks in general are often just a canary in a gold mine. They are a reflection of underlying economies. And people are very concerned about the European economy at the moment. And, you know, there are some good reasons. But the fact of the matter is, last year, European GDP grew faster than the US GDP. This year, Europe is predicted to grow, last I looked, something like 2.7% compared to the US 2.9%. These aren't big differences. At the same time, the US unemployment rate is sub 4%, whereas Europe is still about 9%. And so we think there's a lot of room for European unemployment to decline and to carry through the GDP into the next phase. So we think there's more latent potential in Europe as we stand today. So yes, the current underperformance of ABN AMRO, we think reflects and other European industrials reflects the markets not looking beyond there. But I think if you're going to look a bit further out, there's a lot of potential in Europe. And rarely, if you're going to be valuation focused, that is one of the regions you would look towards.
Now let's talk about distributions. That's an important part of the equation, obviously, for investors. Talk about your philosophy in that neck of the woods.
Yeah, we don't manage our funds for a specific distribution. We're not going to buy stocks just because it's a high dividend paying stock. I mean, we've seen in Australia what can happen if you buy something like Telstra and then it cuts the distribution, what can happen. We're buying growing businesses that are in good valuations and will sustainably deliver for us. Those companies often pay dividends, but as we know, international shares have a lower payout ratio than Australia, so typical distribution yield is 2%. However, the other part of distribution are the capital gains that you take, and we are very, very disciplined sellers.
Indeed. Stephen, it's great to talk to you. Thanks for your time.
Great to see you. Thank you, Tom.
And thanks for joining us for the Executive Series.